bad news for the economy means good news for homebuyers. Second quarter GDP coming in well below expectations. And yet, since that report, mortgage activity has spiked. Mortgage applications up by more than 7% last week as the 30-year fixed-rate mortgage fell for the second week in a row. Joining us right now is former Fannie Mae executive Tim Rood, who is currently serving as the chairman of Collingwood Group. Good to see you, sir. Thanks so much for joining us.
Thanks for having me.
Rock bottom interest rates have had so many implications. You know, whether you look at housing or we were just talking about the markets and very few alternatives. What do you think is the most important implication of this Fed policy that we've been talking about?
Well, I mean, certainly Fed policy has been the savior for the housing market. You can't argue that there's been any policy changes over the last 8 or 9 years that have really helped the housing market. I mean, if you think about it, it's harder and more expensive to find buildable lots. The cost to originate a mortgage has gone up 3x. It's like it takes less labor to build an F-150 than it does to build manufacture a mortgage. Credit's tight. So, yeah, certainly interest rates have been the savior and been driving the housing recovery by a long shot.
I'm not so sure about that, Tim, actually, because if you looked at what happened after the British vote, we had mortgage rates fall down to 3.5%. I mean, that's incredible again. And you didn't see any boost to housing. You didn't see any boost to mortgage applications. It fell flat. It seems to me the Fed is kind of stuck.
Yeah, I mean, you can only pull out the drivers on so many holes, right? I mean, that's the only tool that they really have, the only lever to be pulled. So I think there's a bit of fatigue on the side of, refinances, but it's undeniable that the low interest rates have caused the affordability, that is, in terms of owning a home versus renting a home, is the best it's ever been in history.
In some states. In some states.
For sure.
Yeah.
I mean, you could, everything, housing is certainly a local exercise, but what you can't argue with is that, rents have been going up for the last 8 years, and while you've seen home price appreciation, it's only been going up for the last 3 years, so on a relative basis.
Tim, the policy of forcing Fannie and Freddie to return the capital back to the Treasury, do you think that's a bad policy in the event that we do get a calamity? There'll be another big political/economic crisis on Capitol Hill?
Yeah, I mean, the issue with Fannie Mae and Freddie Mac is it seems to be that the government, kind of like the austerity measures, is really engineering a crisis to compel Congress to act. The Fannie Mae and Freddie Mac were really taken to task for the dual purpose that they serve. Back leading up to the housing crisis, they had a public charter. That means they were serving a public purpose, but they were private enterprises. And those private enterprises were returning, benefits to taxpayers while serving this public purpose. Now you've got a completely different scenario, only in the difference that they're still providing a public purpose. I mean, there are instruments of public policy for the government. But now, instead of the shareholders, which is still a shareholder-owned company, mind you, instead of them getting the windfall profits, it's going to the Treasury Department to the tune of so far about $70 billion above what was invested in those enterprises.
Wow. So what kind of stress does that represent? Because you've got the new stress test results showing that the mortgage giants could be in line to request another $126 billion in bailout funds if there's another economic crisis. I mean, the public is certainly not happy about these companies needing more bailout.
Yeah, that's absolutely sure. I mean, if you talk to Joe Lunchbucket on the street, and if you were to ask them, say, hey, what's your position on Fannie Mae and Freddie Mac reform? They would say, those guys are worse than the Wall Street guys. They took a government subsidy and they misappropriated it and lined their own pockets. So it was like, well, that makes a lot of sense, sure. So let me take you through how, when we reform these companies, how we're going to spend your $200 a month that you're going to pay extra. And let's tell you how this shared sacrifice of that 5 or 10% of value that your property is going to go down. Look, we're all in this together. It's for a greater cause. People get religion real quick when you start talking about real numbers and not just these abstract philosophies.
The idea of splitting these companies away from government and creating mortgage giants that are truly private sector. I mean, I recognize that's a very difficult thing to do given the size of these companies, but will it become a reality at some point?
It has to. I mean, unfortunately in Washington, as you know, Maria, the only time you have legislation is when one of two things happens. There's a crisis, and the government is certainly working hard to engineer a crisis so that, again, Congress is compelled to ask, or that they're going to take on and pass legislation when it really is so it doesn't even matter anymore. So, I mean, we might find ourselves 3 or 4 years from now when you have home ownership rates back up, you have the private sector crowding back into the mortgage market where it's less relevant. And until then, I don't think you're going to see much, because think of it this way. No one's going to get elected based on their housing reform proposal, but heads are going to roll the first time some legislation is passed and it disrupts that $6 trillion market.
That's a good point.
Hey, Tim, it's Shelby Holiday. You know, at this point, are there any government incentives to allow Freddie and Fannie to operate privately? I mean, they're very easy to control. At this point, they're profitable. Does the government want to allow them to operate independently?
It doesn't appear so. I mean, it's a polarizing topic. It's one of these issues that energizes both parties' base. So it's kind of like, I describe it as like tough talking in a mirror. These guys love to talk the harsh talk about reforming the GSEs, Fannie Mae and Freddie Mac, but it really comes down to it. There's no urgency and there's no benefit to the federal government, which is making, as I mentioned, $70 billion thus far and clipping coupons of about $10 to $15 billion a year from the dividends that the GSEs, Fannie Mae and Freddie Mac, pay. So again, great topic, polarizing topic, but no urgency to fix it.
Well, what about rolling back regulations? I mean, when you look at Donald Trump, for example, he's promising to roll back regulations, repeal Dodd-Frank. What kind of ripple effects do you expect from that? And would that affect the housing market? Because the regulatory environment has been one of the issues.
Well, I mean, we know that Hillary unapologetically is basically Obama 3.0, status quo, whatever your point of view on that. I mean, the housing market, as I mentioned, has recovered either because or despite the existing policies. I can tell you firsthand that as a small business owner and somebody in the housing finance sector, less regulation would be a welcome thing. Right now, as I mentioned, it costs almost $8,000 to originate a mortgage. Beyond the cost, and all of these costs manifest in higher cost ultimately to borrowers, higher interest rates, worse service or whatnot, is that these organizations are also under an incredible amount of scrutiny from the administration in terms of the enforcement actions, civil penalties and whatnot. If you had a friendlier regime administration that was not looking for litigation but more partnership with the industry, I can assure you that you would have more affordable credit and more access to credit.
But Tim, hasn't the lending environment gotten just a little bit better over the last 2 to 3 years with regards to Fannie and Freddie Mac? And I say that because that's been a good thing up until now. But this year, for some reason, we seem to be seeing some cracks in the housing market. And this is a very new phenomenon. Can you tell us what's going on?
Well, so the housing market, obviously we mentioned is certainly a localized event. Anything happening is going to be a local. We learned our lesson that home prices don't increase or decrease on a national level leading up to the housing crisis. So there's a variety of different forces at play. But what you are seeing certainly on the mortgage side is that you're definitely seeing a little bit of, on the margins, credit easing. And what lenders had learned, up until most recently is that when they use these government programs, Fannie Mae's programs, Freddie Mac, the FHA, the hard lesson that they learned was that they weren't actually selling the credit risk to these government organizations.
Right.
It felt a lot more like they were renting them.
Tim, good to see you. Thanks so much. Yeah.
Okay. Thanks, Bree.
Thanks so much for joining us, Tim. Tim Rood there. Next.